Hi, welcome back to Joe Blogs. In today's episode, I want to talk about what's happening in the United Kingdom. The United Kingdom is struggling to shake off high levels of inflation, despite the fact that it's introduced 14 consecutive interest rate rises since December 2021. And this is now proving to be a major problem in the UK, and there's a real possibility that interest rates may need to be increased further to get that inflation to start coming down. But one of the major problems that the UK is facing is a housing shortage, which is directly linked to what's happening with mortgage rates. Over the last 22 months, the official rate of interest has increased from 0.1% to 5.25%, and that's had a massive impact on mortgages. And in the UK, mortgages are different to the way they operate in the USA. The vast majority of mortgages only have a fixed rate for a short period of time, often 2 years or 5 years. And a lot of people who took the decision post-pandemic to max out on their mortgage because borrowing costs were very low are now facing huge increases in those mortgage costs. And as the UK has one of the highest owner-occupier rates, that's now causing major concerns that people simply won't be able to afford their increased mortgage payments. And so we could see a flood of property hitting the market, and that could cause a property crash. But it's not just in the private sector that the UK has problems. In the rented sector, the situation is actually worse, because landlords who previously were renting their property have seen a huge increase in the costs of their mortgage. And so they're doing one of two things. Either they're increasing the rental charges significantly to be able to cover the increased costs that they've got, or they're deciding to exit from the rented market entirely and sell their property. And once again, that represents a further risk, because if lots of landlords decide that they are forced sellers, then that could also lead to a flood of property. So the property market in the UK is currently sitting on a knife edge. But the knock-on implication of all of this is that councils in the UK are now facing bankruptcy. Over the last couple of years, we've seen a number of councils declaring official bankruptcy, which is actually referred to as a Section 114 notice, because councils are not actually limited companies, so they don't go bankrupt. They just declare that they've got no money left and therefore they can't pay anybody to do anything. But a new report has now revealed that around 30% of UK councils are now facing bankruptcy as a result of a massive increase in housing costs. There are now officially 104,000 homeless families registered in the UK. So these are people that need temporary accommodation, and the council has to pay for that temporary accommodation. So that's increasing the cost at a time when the price of temporary accommodation is going through the roof. So in today's episode, we'll have a look at exactly what's happening with the UK economy. We'll look at inflation, interest rates, the balance of trade, the current account, and what's happening with sterling, the UK currency. We'll then go on to have a detailed look at what's happening with UK councils and why they're on the verge of bankruptcy. And then finally today, I'll wrap up with my summary. So what I think is likely to happen in the UK over the course of the next 3 to 6 months, and what the impact of this will be on the UK economy. But before we get started on all of that, I'd like to say once again, thank you so much to everybody that's bought me a coffee or sent me a YouTube super thanks. Really appreciate that. It does mean a lot to me. And if you'd like to support the channel, please have a look below where you'll find links to my Patreon channel, where you can see more videos like this and also avoid all of the adverts. But if you don't like Patreon, you'll also find links to buy me a coffee, as well as YouTube super thanks and membership scheme. This chart shows the movement in the official rate of inflation for the United Kingdom over the last 12 months. And what this shows is that in October 2022, inflation was running at 11.1%. And as a direct result of the continued increase in interest rates, inflation came down steadily over the next 9 months to 6.8% in July 2023. However, as you can see from the right-hand side of this chart, in the last 3 months inflation has remained stubbornly high and was at 6.7% in both August and September. And the reason that this remains a big problem is that the target rate of inflation is 2%. So the current level is more than 3 times higher than where the Bank of England wants it to be. And if we expand the scale of this chart out to 25 years, you can see that in the period between 1998 and 2021, the highest levels of historic inflation that the UK has experienced were around 5%. So the current spike in inflation is not something that the United Kingdom economy is used to dealing with. And the 3 main driving factors as to what caused this inflation were the end of the COVID-19 pandemic, which increased demand rapidly at a time of limited supply and therefore drove up prices, Russia's invasion of Ukraine, which drove up the price of things like oil, gas and food, and the UK's decision to exit from the European Union trade agreement, often referred to as Brexit. And this chart, which shows the current rates of inflation for the G20, the 20 largest economies in the world, puts the position in the UK into perspective. As you can see, the United Kingdom has the third highest rate out of all of the countries in the G20, and the only two countries that currently have higher inflation are Turkey, where it's running at 62%, and Argentina, where it's running at 138%. And both of those countries are in a state of economic crisis. And if you look down this list, you can see that the UK currently has a higher rate of inflation than Russia, which recently increased its interest rates to 15% to tackle what the Bank of Russia is determining as an inflation crisis. One of the largest impacts of Brexit has been on the price of food in the United Kingdom. The UK is an island and is a net importer, particularly of food products. And prior to Brexit, a lot of food was sourced from Europe. And as you can see from this chart, over the last 12 months, there has been a significant increase in the price of food. In October 2022, food prices year on year rose by more than 16%. They continued rising at those sort of levels for the next 3 months. In February 23, food prices were up 18%. They rose 19% in March and April, 18% in May, 17% in June, 15% in July, 14% in August, and in September the increase in food prices year on year was 12%, which is almost double the official rate of inflation. And as we've discussed many times before on the channel, the problem with food inflation is that it disproportionately impacts on the poorest members of society because they're spending a higher percentage of their budget on food. So when food prices go up for the poorest families, in many situations they simply don't have enough money to be able to afford what they were paying previously, and so they have to buy less food. And the other major problem in the UK is the cost of energy. Now this chart shows the movement in the price of energy that consumers are paying in the UK over the last 12 months. And what this shows is that in October 22, energy prices increased year on year by 59%. And in the following 5 months, prices continued to rise at extremely high levels. And in March 2023, prices were still rising by more than 40%. Now, as you can see, in relative terms, over the last 6 months, things have actually improved. And in July, August and September, there was actually a year-on-year decrease in prices, 7.8% in July, 3.2% in August, and 0.2% in September. And at face value, you might think, well, that's good news, things are looking up in the UK. But statistics can actually be very misleading, because what we're looking at here is the year-on-year movement. How much did prices increase or decrease compared to this time last year? And if we expand the scale of this chart to show the last 5 years, you can see that immediately following Russia's invasion of Ukraine at the start of 2022, energy price increases in the UK shot up to around 50 or 60%. So the chart that we've just looked at for the last 12 months just tells us the movement in the price compared to prices this time last year. But what we're seeing from this chart is that this time last year, prices were up around 60%. So the fact that prices have fallen 0.2% in September 2023 basically tells us that the 60% increase that we had in September 2022 is still hanging around because we haven't really dropped very much from that level. So what this shows is that energy prices are still extremely high in the UK. They're coming down in relative terms compared to this time last year, but because this time last year represented such a massive increase, prices are now significantly higher than they were historically. And this is another reason that UK consumers are struggling. This chart shows the movement in the official rate of interest in the United Kingdom over the last 5 years. What this shows is that between August 2018 and March 2020, the official rate of interest was 0.75%. It then dropped to 0.1% in March 2020 and remained at that level until December 2021. However, since December 21, there have been 14 consecutive interest rate increases to the current level of 5.25%. And the reason that the UK has been increasing its interest rate is to tackle the high levels of inflation that we've just talked about. Traditional economic theory tells us that at times of high inflation, if you increase interest rates, It increases the cost of borrowing, both for new borrowers and existing borrowers who have floating rates such as credit cards. And higher rates of interest generally discourage people from taking on more debt and from spending. And if there's a reduction in spending, that brings down demand, and therefore prices should start coming back down. And I think it's interesting to compare the current interest rate in the UK of 5.25% with the rest of the G20. And this analysis shows that interest rates in the UK are the 11th highest in the G20, which compares to the third highest rate of inflation that we just looked at. The official rate of interest in Argentina is now 133%, which is incredible. It's 35% in Turkey, 15% in Russia, 12.75% in Brazil, 11.25% in Mexico, 8.25% in South Africa, 6.5% in India, 6% in Indonesia and Saudi Arabia, and 5.5% in the United States. And I think it's interesting to note the way the UK have approached trying to tackle high levels of inflation. The strategy has been to increase interest rates by small amounts on a regular basis, which is different to some of the other countries on this list, which have taken decisions to increase rates more aggressively. And when you consider the fact that the current rate of inflation of 6.7% is more than 3 times higher than the target rate, it tells us that the interest rate increases in the UK haven't achieved their goal, and that if the Bank of England wants to use interest rates to bring inflation down, it's going to have to keep raising rates higher. This chart shows the movement in the value of the British pound against the US dollar over the last 12 months. And as we've discussed before, when you're looking at exchange rate charts, you usually look at the currency with the higher value first. So in this instance, it's the British pound. And what this chart shows is that this time last year, one British pound was trading for around $1.15. The value of the pound started to strengthen at the end of 2022 and in the first 7 months of 2023, and hit a high of $1.30 by the middle of July. However, as you can see from the right-hand side of this chart, over the course of the last 3.5 months, the value of the pound has started to deteriorate again, and one British pound is currently trading for around $1.21. And the falling value of the pound represents a problem for the UK because it's a net importer. This chart shows the UK's balance of trade, which is basically the difference between the value of all of your exports and the cost of all of your imports over the last 12 months. And as you can see, in 10 of the last 12 months, the UK has recorded a negative balance of trade. So basically, it's paying out more than it's receiving. And the figures on this chart are shown in British pounds and show that in August, which is the last month that we have official data for, the UK's trade deficit widened to £3.4 billion. As a result of exports declining by 1.6% to a 14-month low, and imports rising by 1.2%. And this chart shows the UK's current account, which is basically like the country's checking account. And this reveals that the current account was in deficit in every single one of the last 12 months. And the current account gap widened significantly to £25.3 billion at the end of Q2, which is equivalent to around 4% of GDP, and was significantly above market expectations of £15 billion. In the United Kingdom, councils are the government-appointed bodies that are in charge of providing services to all of the residents in that district. The government provides an annual budget to cover services such as education, transport and housing, and each council is allocated a certain amount of money for each financial year. And over the past few years, as the UK economy has got into difficulty, more and more councils are declaring themselves bankrupt. This map of England shows the councils that have officially gone into a bankrupt situation. They're not actually declared bankrupt because they're not limited companies, but rather they issue what's called a Section 114 notice, which basically says that they're unable to pay all of their bills. Hackney in East London was the first ever council to issue a Section 114 notice in 2000 and remained as the only bankrupt council until 2018, when Northampton issued a Section 114 notice. Slough was the next council in 2021, when it declared a £100 million black hole in its budget. Thurrock followed in 2022 after racking up debts of £469 million. Croydon declared itself bankrupt in 2022 with debts of £130 million. However, things started to deteriorate significantly in 2023 when Woking issued a Section 114 notice and announced that it faced a deficit of £1.2 billion. And Birmingham Council followed a few months later with liabilities of around £750 million. And it's now been revealed that around 30% of all UK councils are considering issuing a Section 114 notice, with many authorities struggling to make their dwindling budgets last. And one of the biggest issues that's now putting pressure on these councils is the cost of providing housing, as a result of the multiple increase in interest costs, which have had a devastating impact on the rental sector in the UK. England's housing crisis will push many local authorities into bankruptcy, as the increasing cost of emergency accommodation for thousands of homeless families threatens to overwhelm council budgets. The worst-hit councils are now spending between 20% and 50% of their total financial resources to try to cope with an unprecedented and rapid explosion in homelessness caused by rising rents and a shrinking supply of affordable properties. This table shows the official government figures for the provision of a variety of services provided by local councils. And as you can see from the top of this chart, we've got 5 different years here. The first 3 years, representing 2020, 2021 and 2022, represent the actual figures, and the 2 columns on the right-hand side represent the budget for 2023 and 2024. And if we start off by showing at the very bottom of this chart, which shows total expenditure for all services, it shows that in 2021 total expenditure was £118 billion, which represented an increase of around 9% compared with the £108 billion in 2020. Total expenditure then fell to £116 billion in 2022, which was a fall of around 1.7%, and the budget for 2023 is £111 billion, which represents a fall of around 4.3% compared with the actual figures for 2022. And if we now have a look at which are the main categories that the local councils are spending, you can see that the biggest is right at the top, education, with a budgeted figure of £37.4 billion in 2023. The next biggest category of spending is adult social care at £20.2 billion, followed by the police at £14.8 billion, children's social care at £11.4 billion, cultural, environmental and planning at £10 billion, highways and transport services at a combined number of £7.9 billion, public health at £3.7 billion, and the allocated cost of housing is only £2 billion, which represents around 1.76% of the total spend on services. However, the reality of the spend on housing is somewhat different. This table shows the percentage of their total annual budget that selected councils spent in temporary accommodation over the last 12 months. And as you can see, all of the councils shown on this list have spent significantly more than 1.76%. Hastings Council has spent almost 50% of their budget on temporary accommodation, Crawley 30%, Arran 25%, Swale 22%, Havant and Dartford 13%, Canterbury and Dover 12%, and the rest of the councils showing on this chart have spent between 7 and 11% of their annual budget. And the housing crisis is being driven by rising evictions from private rented housing over the past 2 years, coupled with local housing benefit cuts and the scarcity of suitable homes as rising mortgage interest rates force landlords to sell up or switch to shorter-term lets such as Airbnb, forcing potential first-time buyers to stay in rented homes. UK councils have described increasingly chaotic local private rented housing market conditions as the crisis spreads, including unscrupulous private landlords evicting tenants and then offering the property to the local council to use as temporary accommodation and charging a substantially higher rent, a process known as flipping. Families increasingly being placed in temporary housing miles from where they live and far away from their children's school. District councils in Essex routinely house families in Norfolk and Cambridgeshire, which are based around 100 miles away, and one family was reportedly placed in Inverness in northern Scotland, around 400 miles away. Councils are also in direct competition with the Home Office and its asylum-seeking housing contractors to secure scarce temporary accommodation in their area, and some councils are now considering offering golden hello cash payments to landlords to secure priority access to homes. And the latest published figures show a record 104,000 households in temporary accommodation at a cost to the taxpayer of £1.7 billion. Stephen Robinson, the leader of Chelmsford City Council, said, "As a country, we've not built enough homes for 30 years. If the crisis in homelessness is not addressed, it could bankrupt many councils within 2 years, with those in the southeast of England at particular risk." So what's the summary and conclusion today? Well, I wanted to post this video firstly to give you an update as to what's happening in the UK, but secondly to talk about the problems that are now building all across the economy. As we've seen in today's video, inflation is remaining stubbornly high. It's at 6.7%, which means the UK has the third highest rate out of every country in the G20. However, if we exclude Argentina and Turkey, which are complete outliers in terms of the list, the UK is right at the top. It's even got higher inflation than Russia. And over the course of the last 7 days, Russia has increased its interest rates to 15% to tackle what it says are extremely high rates of inflation at 6%. So inflation remains a real problem. And as we discussed earlier in the video, there were three main factors that caused this inflation. The first was the general increase in demand that was seen following the release of the COVID lockdowns. And the second was the spike in commodity prices caused by Russia's invasion of Ukraine. So both of those are common themes that we've talked about for countries like the USA and the rest of Europe. However, the big factor for the UK is Brexit. In 2016, the UK held a referendum, and it was decided by the majority of voters that they wanted to leave the EU. However, it took around 4 or 5 years to actually get some form of deal put into place. So the impact of Brexit has really only started to kick in the UK over the last 12 to 18 months. And what that's done is to increase the price of everything that was previously being imported from the European Union. Because previously there were no taxes to pay, it was a trade-free area. But the UK is no longer in that trade-free area, and so taxes now have to be levied. And also the countries that are trading with the UK are now renegotiating all their terms. So previously they may have offered a special deal, a discount, some form of subsidy because of the UK's membership of the European Union. However, now none of those countries have to do that. And the implication of that has been a high level of inflation. And unfortunately, from the UK government and the Bank of England's perspective, increasing interest rates won't fix that problem. The whole point of increasing interest rates is to calm spending, which obviously then reduces demand and leads to a reduction in prices. But if your prices are rising as a result of higher costs because you've lost your beneficial trading arrangement with the European Union, then an increase in interest rates won't have any impact whatsoever. So bringing down the high level of inflation remains a major problem in the UK. But another factor that we've talked about in today's video is the knock-on implication of increasing interest rates. The UK has a high percentage of owner occupation, so lots of people own property, and the vast majority of those people have mortgages. And as we discussed right at the start of the video, the majority of mortgages only have a fixed rate of interest for 2 or 5 years. And a lot of those fixed rate deals are now ending and need to be refinanced. And unfortunately, because the rate of interest has increased by more than 10 times over the last 20 months, people are now staring down the barrel of extreme increases in their monthly mortgage costs. And that situation is causing problems in both the private and the rented housing sector. House prices in the UK are now coming down as a result of those increased borrowing costs and also some forced sellers in the market, people who want to now get rid of their property. But the knock-on implication to the rented sector is even worse, because a lot of landlords who were previously renting their properties out are no longer able to make a profit because the cost of their mortgage has risen so much. So they've got two choices. Either they increase their rental costs significantly to cover the increase in mortgage costs, or they sell. But either way, that's causing problems for people who want to rent because there's a reducing amount of rental stock, and the rental stock that's out there is rising in price. So people are having to pay a lot more to get those properties. And that's now causing a record level of homelessness in the UK. And this isn't people sleeping on the street because they've got a drug or alcohol addiction problem. These are normal families who simply can't afford anymore to be able to rent the property that they've been in for the last few years. And the councils in the UK have an obligation to house those people, and those housing costs, those temporary costs, are now causing lots of councils to go into the red, and we've got a slew of councils who potentially may have to declare bankruptcy over the course of the next 6 to 12 months. So the overall summary of today's video is that the UK economy is standing on the verge of a crisis. Inflation remains stubbornly high. It hasn't come down to anywhere near the level that the Bank of England wants it to be. So there is a real possibility that interest rates could be raised further to bring that down. But the 14 consecutive interest rate increases that have been introduced in the UK are now having a devastating impact on the UK economy and could potentially result in a house price crash, a homelessness epidemic, and the bankruptcy of multiple councils over the next 6 to 12 months. So I'll keep you posted on any further news and developments as and when they happen. Hopefully you found today's episode useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.